Good afternoon, everyone, and welcome. We are always thrilled to have you all with us today in this awareness webinar. And it is a pleasure, of course, to see you along and attending such informative webinars. So we hope by the end of the course to the webinar to add value to your daily operations. Now, before I move on with the housekeeping notes of today's webinar, let's introduce myself. My name is Panagiotis Marino, and I am the Programs and Business Development Manager here at the EIMF, and I will be moderating today's webinar. So today's webinar is going to be about 45 minutes, and it will follow a 15-minute Q&A session. Please feel free to use the Q&A box or chat box for any questions or comments. Our questions will be answered after the presentation. The webinar is being recorded and you will be able to watch it later on EIMF YouTube channel at your own pace. Furthermore, the presentation slides will be forwarded to you in the coming days. We're not going to issue any certificate. So finally, if you are experiencing any technical issues, try refreshing your browser so that to overcome any technical issues. Now, for today's webinar, we are going to deliver the achieving operational efficiency in financial crime. This session will explore the constant trend, if you like, of rising cost of compliance, stricter regulatory requirements, operational efficiency, and which presents itself as an opportunity to tackle cost challenging while remaining, of course, compliant. So this webinar provides an overview, will provide an overview of the present challenges faced by the financial services industry and how an optimal alignment of different elements such as technology, processes, and training can mitigate those challenges and offer interesting opportunities. So by the end of the webinar, you will be able to understand the concept of operational efficiency, learn about the current challenges and obstacles to achieving efficiency in financial institutions, and consider what solutions can be applied. Where areas should be involved and how. So before we move on with the webinar, let me very briefly introduce our presenter for today. Hi, Francisco.
Hey,
Francisco Maines. Nice to be having you. Francisco Maines is the former head of data analytics for wealth and personal banking financial crime risk at HSBC. Throughout his career, Francisco has specialized in activities related to data extraction, analysis, and money laundering and financial crime, typologies, operations, customer due diligence, and tax evasion, among other areas. While in HSBC, Francisco worked in other financial crime teams, such as the Financial Intelligence Unit and Global Compliance Reporting. And prior to HSBC, Francisco fulfilled roles in Standard Chartered Bank in London and Singapore. I don't know, Francisco, if you would like to add anything else regarding your professional background. Otherwise, we can move on with the presentation of your webinar.
Yeah, let's go with the webinar. Long story short, on my professional life, I spent most of my life trying to obtain data, analyze data. Before working in financial crime, I was working for NATO doing military intelligence, but very similar jobs. You try to obtain data about the threats or the risks affecting your organization. You analyze the data, you assess the validity, and then you come up with a product that tries to advise decision makers on what to do next, and doing it very, very fast, because sometimes it's very time sensitive, and at lower cost is basically at the core of what we're going to talk about today.
Excellent. So, Francisco, the floor is yours. Thank you very much.
Okay. Thanks, Panagiotis. I'm very happy to be here. Let me share my screen, and I'll put the slides up. There you go. So I'll understand everybody. Everybody sees the screen. If not, just let me know. All right. So we're going to be talking about achieving operational efficiency in financial crime. And operational efficiency is one of these things like, crypto or blockchain. Everybody talks about it. But the reality is that when you ask 5 different people about, what is really operational efficiency, they'll give you 5 different definitions. Even if you move from one organization to the other, for example, in HRBC, actually, we used to call it operational excellence, not operational efficiency, because under operational excellence, we put efficiency and effectiveness. But that's probably, subject for another day, for another conversation. As Panagiotis has outlined, we're going to be talking about what is really operational efficiency, or what is the industry most accepted definition of it. What are the industry's challenges? What are the problems and the issues and the barriers affecting operational efficiency? And when you try to introduce operational efficiency into organization, you try to get better at this. You try to do things faster and more efficiently. How this can be done? What are the benefits of doing it? And how we're building an operational efficiency framework. And then we'll talk about some key takeaways that will be good for you to when this finish, and then question and answers. In terms of key takeaways, and after this session and after the questions, if you don't have the chance to ask a question or you want to hit me up on LinkedIn, please feel free to do so. All right. So what is operational efficiency? Again, if you ask 5 different persons, I will probably be asking 5 different, members of the audience today, and I will get 5 different opinions or 5 different definitions. But in reality, it's a very simple concept: is optimizing your business processes and looking at your business process, which is basically, this is what I have to do, looking at your resources and try to accomplish those business processes in the least amount of time and using the least amount of money. Because if you go to any industry event, either transfer finance here in London or any ACAMS event, just to name 2, everybody wants to do things faster and cheaper, and it's a constant trend within financial services. Because at the end of the day, you're pushed by trying to, for example, process transaction monitoring alerts, a high volume, in the least amount of time. And on the other hand, you're having the regulator asking you, are you doing this? Are you doing it, right to the highest standards? Are you controlling the risk? So you need to be able to do things very, very fast. You need to spend the least amount of money, doing it, and at the same time, you need to accomplish, your regulatory requirement. You need to accomplish the mission that the regulator is telling you to do. So essentially, need to perform multiple activities related to financial crime operations. That could be sanctions screening, transaction monitoring, fraud, trade surveillance, in a fast and cost-effective way, and at the same time remaining compliant with regulations. Because, for example, if you're fast, but you're cutting corners, you're reducing your processes, and you're trying to, for example, doing things like bulk closing transaction monitoring alerts. Oh, I have 2,000 alerts. They look very similar. I'm going to close them, all of them, at the same time without a proper justification. Yes, you're being fast and you're being cost effective, but the regulator is probably going to come down to you and ask, how were you able to close 2,000 transaction monitoring alerts, with just a click of a button? And then you're going to have to explain that. And if the explanation is not satisfactory, you're going to be in trouble, or your financial institution is going to be in trouble. So what are the things out there that are preventing financial institutions to do things faster and cheaper and and complying with regulation? And the first one is manual processes, because despite the fact that everybody is using computers, many processes lack automation. And if you're looking at things, for example, when organizations are still onboarding customers using paper, that implies a manual process. You're going to have to at some point transcribe that into a logic, into data that computers can read, and that is time consuming. So that is going to slow you down. Another one is resource constraint, because everybody and every single team, I never heard anything like, in all the years of my career, I never heard anything saying we have too many people. It's always the other way around. We have too few people to do all the tasks that we have allocated. So for you to have an idea about the size of these teams in large financial institutions, when I was in HRBC, I left 3 years ago. When I was in HRBC, fraud operations was 7,000 people. Just to put things into perspective, I live in England near London in a village of 2,000 people, a very, very small village. So imagine that everyone in the village not only works for the same team, everybody reports to the same boss. I mean, the numbers are astonishing. But what happens is that, as many of you already know, is that the jobs and the daily tasks related to, for example, transaction monitoring within the context of money laundering are very, very tedious. And one of the things, for example, that we did in the bank is analyze how often a transaction monitoring analyst finds, let's say, a good alert. Because we all have heard about, the term false positives, like something that the system will say, you need to analyze these alerts. And then we analyze it and it's a false positive. So there's nothing wrong with the transaction. So imagine that you go to work on a Monday and it's a false positive, the first alert you check during the day. And you finish the day, you've checked 50 alerts, and they're all false positives. So the system thought there was something suspicious, but you did the investigation, there was nothing suspicious, you move on. And then 2 weeks go by with the same outcomes. So you're processing hundreds of transaction monitoring alerts until you find one that you can actually escalate and go to your boss and say, we need to investigate this. We need to take it, we need to escalate it to the next level of investigation. So imagine doing that for months. So it's not surprising. It's not surprising that the attrition rate in financial crime operations is astronomically high. I mean, many people arrive to this job as university graduates, for example, and after a few months, they will resign looking for something else because it's incredibly boring. So that contributes to resource constraint, to having less and less people doing these jobs, which is why the industry is more and more looking at firms like the one I'm in, a technology company, saying how we can replace all this attrition using software, using machines. Another challenge is that data are in silos. Sometimes you will need to investigate a transaction monitoring alert, but in order to check out that alert or classify as good or bad, you need customer data, and customer data will sit in another system. If you're lucky, you will need to log in into another system. If you're not that lucky, you will need to request that data to be sent, probably in the shape of an Excel spreadsheet, to your inbox. That could probably take a couple of days. So that's siloing. That data being processed in different silos is going to make your job slower. There's an increase in false positives. The more alerts we're processing, or the more transactions we're processing, the more the chances that they're going to increase. Uh, After COVID, or during COVID, actually, we push large segments of the population that they were working with cash now to work and operate and transact, electronically, and that has dramatically increased the volumes that the volume of transactions that need to be screened, that need to be monitored and analyzed, and many of them are going to be false positives. All of these, we need more people, we need more time, we need more machines. There's a cost. Nothing is free. We need to feed the people. We pay them the salaries. We pay them the extra hours. We need to buy new systems, and it increases cost of compliance. And compliance in a bank traditionally has always been seen as a non-revenue generated function. Because if you work in private banking and you bring customers, you're going to make money for the bank. But if you work in compliance, you spend a lot of money, but you're not bringing new customers. As a matter of fact, you keep telling the business, we need more money to monitor all these customers. Mm? And that's, again, it's a barrier, because money is like people. There's never money to go around. So again, we already talked about the increase in alert volumes. The more alerts, the more time you need, the more people you need, the more systems you need. And last but not least, we come with a term that appeared about 3 or 4 or 5 years ago. I never seen it before. Before that, it's called alert fatigue, and basically refers to what I've been talking about going every day, processing hundreds of transaction monitoring alerts, and every day is the same, and every alert is the same outcome. So at some point, quality drops because you're doing the same job day in, day out with no reward in sight. So either you leave and look for a higher, better paid job, or a completely different job, or quality is going to drop, and if quality is going to drop, that's going to have a knock-on impact on how good are you processing those alerts. So when we look back and we need to try, okay, so we're going to scratch our heads. We're going to have many people around the table: IT, the business, compliance, operations, systems, investigator. How are we going to fix this? And one of the most common approaches, and there's many ways to fix this, because financial institutions will have either all of those challenges that we've seen before, or one bigger challenge, and the other ones are, let's call it accessory or secondary, or a combination of some of them. But a good recipe to try to fix this, a good approach to try to fix this and gain and increase your operational efficiency, so you're going to be able, again, to do things faster and cheaper, is to improve your detection. So if your detection is good, obviously you're going to produce less alerts. Less alerts means less false positives, means less time processing alerts, means less people that I need to process those alerts, because maybe I don't need now 7,000 people like before. I just need 5,000. And I can probably use those 2,000 to be used into something else. So I can move my workforce around. So you need to review your detection rules, your detection approach, and identify methods to reduce false positives. So for example, if you have a transaction monitoring scenario that is aimed to detect transactions above 50,000 US dollars, and you play and you do some analytics and you play, it's called above and below the line. You play with the threshold, with the 50,000, and you find out that the optimal point is go for detection on $48,000, because that's going to produce much less false positives. You are still satisfied your regulatory requirements of having high threshold transactions, and being monitored. But now you're producing less false positives, you're producing less alerts, and now you can use the manpower. You're more efficient. You can use the manpower to do more stuff, to produce, to be productive in other areas, to look at other detection scenarios. And this is a process called a scenario or rule optimization. You optimize the detection rules, to be more efficient, to produce, the exact number or close to the exact number of transaction monitoring alerts, if we keep talking about transaction monitoring, that your team of 30 or 50 or 100 people can manage and still remain compliant. Another part of the approach is benchmark, which is, and for example, many of our customers, they will always ask, how are we doing in respect to our peers? So obviously you're not going to tell somebody in HSBC, oh, Barclays is faster than you, but there's ways to anonymize the data. And because we have customers, for example, in the company that I'm working on in Actimize, we have customers like Barclays or HSBC. You can tell them your peers take an approximately 45 seconds to review an alert, whereas you take 1 minute. So you spend 50 seconds more per alert. And now if you multiply 15 seconds more by 2,000 alerts more, and each working hour is something like $50 US, now you know that you're these many $1,000 more expensive than your peers. So you know that you're basically less efficient if you're in Barclays, for example, than HSBC, without having to tell who's Barclays or who is HSBC. And this is particularly useful when you operate using the cloud, because we can access the cloud from our end, from the software developer perspective. We can get the data, we anonymize the data, and we go to the customer and we say, you're on the top 5 or high performance in your business, and they'll say, oh, thanks very much. Or you're on the top bottom, so you should probably be doing something about it. Or maybe you're taking, you're taking 1 minute and you should be taking 45, because if you take 1 minute per alert, means that's for example, for something that we call level 1 alerts, and you're going to spend more time on level 2 alerts. And by the time you're able to compile a suspicious activity report, and you are in a jurisdiction that you have 15 days to compile a suspicious activity report, all the time that you need to process those alerts, to investigate those low-level alerts, is time that you don't have to produce your SAR, your suspicious activity report. And if you're consistently late to the regulator submitting those SARs to your financial intelligence unit, your regulator is going to come back to you and say you're late, and this has been actually examples of fines or regulatory fines to financial institutions within the European Union very, very commonly. One of the approaches that you can take is what we call targeted outsourcing. Outsourcing has been in the financial service industry working for many years. We all know about all these big data processing centers or big operation centers in places like in India, China, or the Philippines. Initially, outsourcing was an approach taken essentially to offer lower costs, to optimize operational costs, to reduce cost of production. Today, because alerts and investigations are becoming more complex, that's what we call targeted outsourcing. So you have companies like ours, for example, offering teams of financial crime investigators that are specialized in things like, I don't know, trade-based money laundering or sanctions screening, and you can deploy them to help financial institutions to say, okay, so you are a financial institutions in Asia, you have big spikes of transactional activity in things like Chinese New Year because everybody is going out and buying presents for the family. And by buying presents for the family, increase the number of transactions, and the number of transactions increase the number of alerts. So we can offer you a team that was going to be deployed for like 3 months, targeted to this very specific event, like to minimize the spikes, and then we can move the team somewhere else. So again, we we're trying to do things cheaper and faster, but we do it in a smart way. We're not just going to hire, oh, we're going to put 3,000 people that during 10 months of the year they're going to be idle. They're not going to have high volume of work, but I have to still pay them a salary. So being efficient means things like this: identifying when you're having things like seasonal spikes and applying a solution to that seasonal spike. And then you move on, you deploy the team elsewhere. So you're not spending a lot of money paying people that 10 months during the year, they're not going to be very, very busy. So you do it for just 2 months. That is a good example of being efficient. Because at the end of the day, what you want to do when you do an operational efficiency review is identify gaps, enhance the efficiency, saying, why do you need 8 people to do this when, if I use benchmarking, your peers use 6 people? So there's two bodies that you don't need to use. Why are you taking, 5 steps in a process, and at the end of the process, you're spending 2 minutes because this and this step, I could actually automate it. I could actually, integrate these two systems so they talk to each other. There's no manual data transfer. By eliminating, by doing that integration, I'm eliminating those 2 steps, and now you go from 2 to 1 minute. So again, you multiply that 1 minute by 5,000 employees, and 5,000 minutes is probably a lot of money in the long term. So at the end of the day, again, you want to reduce the cost of compliance, and you want to address the lack of capacity. And I put an example before saying, now you don't need 6,000 people to do this. We've reviewed the processes. Now you need 4,000. So the remaining 2,000, that doesn't mean that you're gonna lay them off, but you can send them to do other things. You can send them to do credit operations. You can actually send some of them to do complex investigations, and that's how you manage your resources, your time, and still try to remain compliant. And that's the essence of operational efficiency. And when all of this that I've been saying so far goes well, the benefits are not limited to what you're seeing on the screen, but those are the ones that any financial institution would expect to reap in terms of benefits. And the first one is cost reduction. Now, because you're going from 6,000 to 4,000 people, because now you have much less false positives, you can send those 2,000 people to credit operations. So they'll stay in the bank, but if you are the head of financial crime operations, that is not my budget. Somebody else's budget. I'm reducing the cost. You can improve your resource allocation. Following with the same example, I can actually use people that are not busy now to send them to busy pockets. So, for example, one of the things we did in the bank in HSBC, we fundamentally changed the level one, the most basic investigation level. So we were able to send analysts to working from money laundering operations to work in fraud operations. And 6 months later, COVID kicked in. The numbers of fraud cases literally skyrocketed, and having that extra manpower to send to fraud was a really, really good thing. Your investigations are enhanced because now you have more time to look at investigations, and and the difficult part is always not the investigation itself, is gathering the data. One of the things that again, we used to have when I was working in NATO and also in financial crime in big banks, is what we used to call the 80-20 80-20 problem. Analysts typically would spend 80% of the time getting the data that they should have in the first place, retrieving the data, sometimes getting it from external sources, sometimes having to write an email and get the data imported from somewhere else, and only 20% of the time to do proper analysis, to try to analyze the data and say, okay, so this is telling me, for example, that in Australia, Canada, and the US, you have a segment of population like students, which they should typically be on a lower bracket of income, buying high-end properties. And if you don't have time to analyze those patterns, you you still need to analyze 500,000 alerts, and basically that is stealing your time. And those are the things that will probably go under the radar. So if I'm able to reverse that 80-20, and now I only spend 20% of the data, and I have 80% of my time, 20% retrieving the data, and now I have 80% of the time to produce the analysis. Now that is how you enhance your investigations. Now is that when you can discover things that before you would have never found. Mm. You can also improve your customer experience. Everybody hates sitting in the sofa on a Saturday afternoon. The phone rings and it's the bank, and the bank somebody says, "Oh, we would like to talk about some of the transactions that you have made over the last 2 weeks." And you're like, "Oh, it's my day off. Come on, can we do this? Sometimes else." So if you improve your quality of your investigations, means that you don't need to call your customers, and means that you improve your experience. Because I can tell you, if you start calling your customers, at some point they're going to start calling you back saying, "I'm not satisfied with the service provided by this bank." Because every time I do something, like sending money to my parents that live in another country, they live overseas, or my daughter who is studying a degree in the US or Canada, you call me for the same thing. And I have a personal example with that. Before the UK, I used to work for a British bank in Singapore. In Singapore, you get typically your target bonus, something like in February, March. So I moved to the UK in March 2013. So basically the same month that I got my big target bonus, it was actually a big bonus, I may add, in Singapore, and then moved to London. So what I did at some point is, okay, I'm going to move my bank account, my savings, my bonus, and everything. So all of a sudden, I land in the UK without never being lived here, and I bring all this money. So I started to get calls from the bank saying, "Where is all this money coming from? Can you justify these transactions?" And the first time is not bad because you'll say, "Okay, good that you asked because you proves that your controls are working." So I explain, "I'm a bank employee. I'm coming from this bank in Singapore. This day I left Singapore. These transactions is basically me moving my money because I'm not going to live in Singapore. I'm going to live in the UK, and I want my money where I am." But the day after, somebody else called me, and the week after, somebody else called me, and it was exactly the same question. So to me, my bank at that time had a problem of internal communications, or I could see that 3 or 4 or 5 different transaction monitoring or KYC cases had been opened by 3 or 4 or 5 different analysts, but nobody was talking to each other, and the system was not talking, systems were not talking to each other because every day I had to answer the same questions. And one day I said, "I've had it." So I went in person to the bank and said, and I wrote basically the story on a big email and said, "Here's the story. Could you please stop calling me? It was a bad customer experience." So if they would have done their homework in terms of processing those alerts, because that means it's only one customer, but imagine that they're doing that for another 200 customers. How many times they're wasting 5 different analysts analyzing the same case, the same person, and the same typology? You multiply that by thousands of customers. HSBC had 10 million has 10 million customers, sorry, in the United Kingdom alone. So imagine wasting time at that scale. And at the end of the day, those analysts, either they're doing a good or bad job, they want their salary. So you have to pay them. So it's an immense waste of operational cost in compliance. And last one is faster turnaround. The faster you do your investigations, the more efficient you do your investigation, the next you can jump to the next alert and to the next alert. And before you were doing 48 alerts a day, and now you're doing 64 alerts a day. And it's a combination of better processes, better systems, and better training. Because at the end of the day, one of the things that you trigger in an operational efficiency review is you're looking at everything. You're looking at how they're doing the things they're doing, and they probably have a process map and an SOP, a standing operations procedure, basically a document that says this is how we do things, this is how we analyze alerts. So you review that and you put that under scrutiny. It's almost like an audit. And you ask questions like, why you take 6 steps to do something that we could probably automate and you could probably do in 2 steps. So I'm saving you time. Now I'm combining a better process, a more streamlined process by applying technology. Sometimes it's not technology what you need, is okay, so you have a financial institution that has a multinational geographical footprint, and everybody's looking at alerts in the same way. When, for example, if you will be looking at alerts, and especially in big institutions, they will have a team, for example, and in the morning they're doing transaction monitoring alerts from Malta, and in the afternoon, they're doing transaction monitoring alerts from Bermuda, completely different jurisdictions with completely different typologies in financial crime. So you train them to analyze those transaction monitoring alerts, not from the criteria that one size fits all. Like I'm looking at them with the same checklist, looking at the same points that I need to check. You're telling them when you're looking at Malta, you should be looking for things that are indicative of typologies of financial crime using cash, because Malta is a very cash intensive jurisdiction. But in the afternoon, you change the hat for Malta and you put your Bermuda hat. And in your Bermuda hat, you should be looking for things like sanctions, because it's a proven fact that people from sanctioned country, sometimes what they do is they do economic citizenship, which is basically they buy a passport from Bermuda. So you should be looking at somebody who allegedly lives in Bermuda but has a Middle East name or an Asian name, and said, okay, so I have a high volume of alerts of people with names that could be correlated to, for example, North Korea, and they're saying they're living in Bermuda, so something is wrong. I need to investigate that. So by doing that, you become faster because you are looking at alerts and you're able to distinguish which ones are false positives and which ones are true alerts. And the way we build this, when we go into a financial institution, you look at all these things, you review all the, who is involved into these processes, identify your stakeholders, you talk to them, you do something called discovery sessions, and you look at the structure of the teams, the processes these teams are following, the data they're using, the operating model that these people are basically using to talk to each other, the staff training that they do, and then you build a new model. So this is now how you're going to be doing things. And then you go into the operate phase. So you deploy the new solution or the new model, and then you start looking at how you can optimize, although you've been using it in other places, but every company is different, every client is different. You're looking at how to optimize your process and your model and align it to the realities of this client. So for example, it's not the same a bank than an insurance company. A bank is going to be looking at a lot of potential money laundering and fraud. An insurance company will probably be looking more at fraud than money laundering, and especially sanctions. And then at some point, you've been basically advising that financial institution for a while, and at some point, it's like when you learn to ride a bicycle. At some point, you go solo, and then you transfer. So we go from build to operate to transfer. You transfer all the knowledge. You're basically saying you're good to go to operate with this new model. I'll come back in 3 months and I will perform what we call a post-implementation review. I'll review again your processes, because it's a very common practice that you'll give them a process, and within 6 months they're doing the old thing, because we're creatures of habit. We're human beings. We want to do what we know. So sometimes when you try to instigate this change in a financial institution, the difficult thing, sorry, is not to start doing the new thing, is to stop doing the old thing, because this is the one that we've been doing for 20 years. And that's one of the biggest challenges. And at the end of the day, everything that I have been saying, when you start, oh, we need to be faster by 15 seconds. We need to be cheaper because now we have 2,000 minutes of working time that we are cutting down. You need to be able to measure all this. You need to be able to measure the progress. You need to be able how fast that progress is, and is not fast. Start questioning why, because data at the end of the day is what is going to tell you how good or bad you're doing, and how fast or slow you're getting to the next goal, to being in that operational efficiency journey. How fast are you accomplishing your goals? And you're going to be looking at what is your overall operation cost. Is it diminishing over time? What is your uh, average processing time for alerts? What is your training compliance, or your training completion rate? Is everybody doing the training? What is the average investigation duration time? Oh, so it was like last month we had a 15% reduction, so we're good, we're doing good. And maybe it gets to the point initially, when you apply all these criteria, when you apply the new processes, you can see that people get faster very, very quickly. But at some point, the rate of speed is decreasing, which is like when you're driving your car. It's very easy to go from 0 to 100, but go from 100 to 150 is probably more problematic, because the engine is working, you know, is let's say is busier trying to get you to that stage. So the same thing happens with operational teams. Initially, you get very good results, but now trying to get better is a little bit more, of a challenge. And then you need to start looking at, for example, things like, your volumes. Are your volumes decreasing? Or they're actually increasing, but you're actually using the same amount of people, which means that you're doing pretty good. Mm. You need to use governance to disseminate your results, which basically means you need to be able to disseminate those results and tell all the bits of the bank, this is how we're doing, because it's actually a good practice to share, data and to share those type of results. And you cannot be complacent. Every now and again, you need to review and assess the metrics, because at some point, say, are we sure that are we measuring our efficiency just by measuring the time that we spend on alerts? Because over the last 6 months, we just cannot go faster. We seem to have achieved, this is as fast as we will ever be. So now, considering that, and we are at all, training, good levels of training, we should be probably looking, out of the metrics. Like, for example, how many more alerts, can we absorb until we start losing speed. So what is the optimal point? And you keep pushing, basically your boundaries of your efficiency. It's pretty much what an athlete does. I mean, an athlete will start, training, and at some point, it gets to the point that even like, a hundredth of a second counts in order to win the gold medal. So it's pretty much the same process. What can we tweak now to achieve that a hundredth of a second? Because a hundredth of a second multiplied by 10 million customers could go a long way. And we're getting close, to the end of this session. So we'll go in a few minutes to Q&As. In terms of key takeaways, what are the things that I would like you to take away from this session and go home or back to your offices? There's a growing and constant demand to perform operations faster and lower cost, and that's not going to go away. So if a few years ago, with the introduction of advanced technologies like machine learning, artificial intelligence, one of the things that we have discovered is we can do things much faster thanks to that. But now we can do things faster with artificial intelligence, but because the algorithms are very complex, we're going to have another problem, which is explaining to the regulator, how are you so fast now? And you need to demonstrate that before you were doing 5 financial crime cases a day, now you're doing 15. are you sacrificing your quality in terms of a speed? So you're faster now to the expense of quality. No, you need to demonstrate that, because I could use something like ChatGPT, generative AI, to generate narratives for my cases. Because at the end of the day, when you write a case, transaction monitoring case, a money laundering case, you need to write a lot of stuff. You need to write this customer, and this customer has all this transactional activity, and this customer has been transacting with us since 1986, and here's the list of products that this customer have, and here's the 15 transactions that we think they're suspicious, and he was going to these 15 different customer into these 5 high-risk jurisdictions. Now with ChatGPT, you can probably generate that. You can tell ChatGPT something like ChatGPT, can you generate a case narrative, basically the story, to tell all this using this data from these different data sources? ChatGPT is going to do it like this, very, very fast, or a Gen AI, a generative AI application, but you still need to review it. It's not like you're going to have Gen AI doing the job for you. You're going to click a button and it's going to go to your boss. So technology can help you do all these things and become faster, but you still need to fulfill the responsibility both at the company level, like you're just going to push the button and send it to your boss without reviewing. You need to make sure that what the algorithm has written is correct, and also you need to prove to the regulator that you're using the correct data sources and you're following due diligence and due process. So it's not just being faster. You have to be faster, but you have to be smarter. Mm. Another key takeaway, uh, financial institutions always are in need to look at their processes periodically when they introduce new technology, when they're forced by the regulator will probably say, look, you need to find a way on how to do this thing better, because you're consistently late at sending your regulatory submissions. We're going to fine you for this. So that's a really good time to call somebody and say, can you help me get more efficient? And I want to spend less time writing these things because every time I'm late and the regulator is beating me. Mm. And one key, one very, very important thing, operational efficiency is not just about throwing technology into the problem. You need to look at not only technology, maybe your technology is old. You need to look at your AML policy. Is it fit for purpose? Or it was last reviewed 10 years ago. The world has moved a lot over the last 10 years, including COVID and things like the war in Ukraine. So you need to check, your sanctions policies, your AML policy, if it's adapt to the new geopolitical realities, if it's aligned with the new with the technology stack that you have, how your processes being adapted to all that. Is your training is your training fit for purpose? When was the last time your staff was trained on this? Do they do mandatory training once a year, or they do once a year and then a refresh halfway through the year? Are you promoting training like commercial certifications like ACAMS or HCFCS or EIMF? Are you promoting these things so they can go and train using companies like, for example, EIMF? And then needs to be measured to check on progress. Because if you're saying I'm getting good, that's another very important key takeaway. If you say you're getting good, but you don't have data to prove it, you're not getting good. You say you're getting good, which is something completely different. So you need to be able to get better, but at the same time prove it using data. And I believe that concludes this presentation. And Panayotis, I think we can go to Q&A.
Of course, of course. Thank you for the insights, Francisco. Of course, technology and AI is here to stay and to make our life easier. There are also implications, but we need to find a way to overcome any implication that may arise. So just a reminder to our participants that now the floor is open to send your questions and comments so that to be answered by our presenter today. I think we have a question. Yes, from Diorah, if I'm pronouncing it correctly. It says it's asking, as DeFi cryptocurrencies and blockchain gain traction, how can compliance teams efficiently monitor and mitigate financial crime risk in this rapidly evolving space?
That's a really good question. And the answer is basically by doing what compliance teams they need to be doing. They need to readapt to the reality of cryptocurrencies and blockchain and decentralized finance. So, or if you will be running a team on this, or let's say you run a financial institutions. Some financial institutions they have a very low risk appetite for customers transacting with crypto. But some others they'll say, yeah, you want to transact with all this, go ahead. But you need to have the tools to detect that, and you need to have the skills to investigate that. So, for example, in places that I've been, they don't have a specialized tool like a chain analysis or Elliptic. Those are software companies that produce a specialized blockchain transaction analysis software. But there's other ways that you can do it using traditional methods, using traditional transaction monitoring systems. So you will not be able to see when money using crypto goes from A to B, because that goes in the blockchain, and your system is not advanced enough to look, or not specialized enough to look into the blockchain. But you can say Francisco has been transacting with cryptocurrencies like 50% of his annual turnover, of his transaction activity, annual transactional activity, and our threshold. So we're satisfied in terms of risk appetite is 25%. So Francisco is probably going to receive a telephone call from his bank and ask about those transactions. If you have the tools to do this, tools like that and skills like that is like any other skills. I mean, blockchain is surrounded because blockchain is, let's say, not conventional. It's surrounded by this halo of mystery. But the reality is that crypto is not completely anonymous. Is not as open, obviously, as a traditional electronic transaction where you're going to see Francisco Miners is sending money from A to B. Mm. But yeah, there's tools that they can decrypt transactions going on the blockchain, and that's how you see in the news that criminals using blockchains they've been arrested. They have been arrested because the financial intelligence units and banks, some of them they have the tools, the necessary tools to do this, and the processes are not very different to traditional process. You just need the tools and the processes and the skills. And if you're working, for example, if you would be working on a crypto exchange, fine, because you operate on the blockchain. If we will be talking about a traditional financial institution, you need to basically integrate now crypto and your crypto systems and the data with the rest of let's say the other the other traditional stack. But yeah, it can be done. It's not very much different from what other people from other people sorry, it's not very much different from operating from traditional to crypto. You just you're changing tools.
Thank you, Francisco. Just checking to see if we have any other question. Not for now, but I have a question to make.
Okay.
Is operational efficiency a common, let's say, reason why financial institutions are fined by regulators?
It is indeed, because even if the regulatory, for example, let's suppose a financial institution is fined X amount of million of dollars or pounds for failings in the financial crime risk framework. And when you look on the failings, you see things like, for example, consistently late submission of suspicious activity reports into the financial intelligence unit. That is an efficiency problem because it means that from the moment you took the transaction to the moment you develop a SAR, from the moment you saw, oh, this transaction may potentially be suspicious, until you reach here and you write a SAR, the MLRO, and that will go to the financial intelligence unit. Many jurisdictions they'll have very very strict timelines to from that moment to this one. And I can quote, for example, in Australia, if a transaction it has been identified as suspicious for terrorism financing reasons, you have 72 hours to write a SAR. That's incredibly fast. So if you're consistently late, the regulator is going to find you. So you have 72 hours. So you really have to know what you're really doing and have really good processes. So, you can escalate that one and say, I need a mechanism not only to identify that this transaction is suspicious from terrorism financing, but to prioritize that, to elevate it to the next level, and to be able to write the SAR very, very quickly. So anything related with time, or achieving results, to me, is a failure in operational efficiency.
Okay, good. Okay. And what is the role to be played by AI in operational efficiency?
AI plays a key role because it's going to give us more speed. And uh, if you, for example, some of the developers that are using generative AI, technology to do SARS, for example, uh, they claim they can reduce investigation time and writing narratives by something like 30%, which means that before you were able to write 5 cases a day, now you're writing 15. But the key here is being intelligent when using artificial intelligence, or being smarter when using artificial, and basically on two fronts. One is the managerial one, because I'm sure if we will be asking the audience, when you get the mandatory training from your company, how many of us, and I've done it, how many of us do click, 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 I'll see you next year. And if you do the same thing in a real production environment with financial crime, yes, you go from 5 cases to 15 a day, but you're sacrificing quality to the expense of time. You're much faster now to the expense of quality. And so, the first round is the managerial one. So if you implement artificial intelligence in your company, you should have controls to prevent this. And you have an analyst that goes from 5 to 15. You should probably have a performance conversation and say, could you please explain me what are you doing to do this, and still doing it the right way? And the other front is obviously the regulatory one, because you should be able to again use artificial intelligence and use things like generative AI to be faster, but at the same time justify your results with the regulator. And I remember a case; it was actually a broker in the U.S. that they implemented an algorithm that was able to write SARS much faster. But then FinCEN, which is the U.S. Financial Intelligence Unit, came back and said, 75% of your SARs are absolute garbage. And they're garbage because the algorithm that they use was not adding essential elements of information into the SAR. So you automate SAR production, but imagine that when you need to write about the customer that is the object of the investigation and a suspicious activity and all the rest of it, the algorithm is not putting the customer name or the date of birth. So that omission on key data it wasn't a massive fine. It was something like $250,000, but it proves the point that if you're not smart when using smart solutions, then you're going to get in trouble. You need to adopt technology, but with using proper controls.
Thank you for the insight, Francisco. We have a comment I can read for you from Neil. On the point that greater efficiency also introduces greater complexity, the problem is not only to demonstrate compliance to supervisors, but also creates a culture of dependency on technology. I feel this is a situation which should be avoided, as it will hinder the ability to capture faults and improve systems such as transaction monitoring. I don't know if you would like to make a comment on this. You can have a look again.
What is it? Is in the Q&A
The
window?
Q&A, yes,
Oh, there you go.
from
Yeah,
Neil, yes.
I agree. I agree with Neil. Because again, you need to be looking when you're looking at operational efficiency. One of my key takeaways is that you need to be looking at technology, but you also need to be looking at processes, and you especially need to be looking at people. Some of the worst failures that we've seen in the industry, or I've seen even when engaging some of our clients, is in culture. The systems are good, the processes are not bad, they could be improved. The data is always garbage wherever we go, so we have to live with that. But the culture was atrocious because, in some cases, the business who wants to generate money is basically pushing compliance to basically cut corners, and to the point of, okay, if you onboard the customer and the customer starts transacting, and obviously you should put your screening controls at the beginning of that cycle. So if you have somebody, it's an extreme case, if you have somebody from North Korea, you cannot stop it. I'm sorry, you're sanctioned, you cannot join the bank. But the business was pushing, compliance to basically say, just onboard the customer, just get him into the house, and then you do the checks later. and that brought a massive fine onto the company. So it had nothing to do with had nothing to do with technology, but it had a lot to do with willing, wanting to make a lot of money to the expense of financial crime controls. So to me, that was a cultural problem. I agree with Neil. All those things, they need to be taken into consideration. We naturally tend to look at technology as the mother of all problems, but sometimes it's not just that.
I hope Neil got his answer of this on his or her comment. Okay, we have another 4 minutes. If anyone wants to send a question or a comment before the closure of today's webinar. All right, a last question from my side, Francisco. When is a good moment for a financial institution to trigger an operational efficiency review?
Anytime is good. I mean, there's clearly moments when, for example, if you're making a fundamental change in, let's say, in your technology, or a fundamental change in your processes, or you have a regulatory action on top of you, you definitely need to do that. Even if you think, things are going well, every now and again, you should stop, look back, and think, I probably need a review to effectively ensure that things, are going well. It's like, for example, an AML policy. The fact that you've been using the same AML policy and you didn't have any problems for the last 5 years doesn't mean that you're doing good, because there's a lot, there's a lot of things that have happened over the last 5 years in terms of regulation and financial crime typologies. So I think at the very least, critical functions like financial crime operations should be put under under an efficiency review. It doesn't have to be like a big overhaul, but just a basic review, and things like, how fast are we processing alerts? How good are we coping with those volume of alerts? What is the attrition rate, at the very least, on a yearly basis?
Right. Okay. Good. All right. Cannot see any other questions or comments. All right. We're heading towards the end of our webinar, so we need to wrap up. If you'd like to learn more about the role of technology compliance, Francisco will deliver a course on the 3rd of March. The course is called Technology and Financial Crime. Feel free to visit the EIMF website to find more about the course and register yourselves. Otherwise, you can just send us an email and we can provide all the information to you. So thank you all for your time attending this webinar, as well as, of course, your contribution with the question and comments. And we sincerely hope you found it enjoyable and viable. Special thanks, of course, to our presenter, Francisco. Thank you, Francisco, for your time to present this topic and offer your insights. And as already mentioned, we're going to forward the presentation slides the following days, and the video will be available on EIMF's YouTube channels. And because I have received a question, no certificates will be issued after the end of the webinar. So thank you all once more, and we're looking forward to see you in our next webinar. So stay tuned and enjoy your afternoon. Bye-bye for now. Thank you.
Thank you. Thanks, everyone.